Hi everyone, I'm Chris Lee from the group of Diamond Forever to explain what is the financial planning. My team members are Alex Hu, Dr. Ye, Eileen Teo, Jessica, Matthew Yu, Leon Tan, and Peter Lee.
What is financial planning? When a company starts, financial planning is very important and it's the most vital factors for a company. A company, whether it make it or lose it, it all comes down to financial planning. Definition of financial planning. The process is the process of estimating the capital needed and assessing its competition is known as financial planning. In the method of establishing financial policies for an organization's acquisition, expenditure, and administrations of funds. The objective of financial planning is to identify the requirements. This will depend on the factors such as the cost of existing and fixed assets, promotional spending, and long-term planning. Capital needs should be examined from the following two angles: short-term and long-term needs. We also have to identify the capital structure. The capital structure refers to the capital composition or the types and proportions of capital needed in corporation. This cover both short-term and long-term debt to equity ratio decisions, and outlining monetary approaches concerning cash control, loaning, borrowing, etc. The financial managers ensures the best use of scarce financial resources at the least possible cost to obtain maximum returns on investment. Importance of financial planning. Financial planning is the process of developing objectives, policy, procedures, programs, and budget related to the financial activities of an organization. This ensures effective and appropriate financials and investment policy. Importance can be underlined as follows. Sufficient funds must be ensured. Financial planning helps to ensure a reasonable balance between disbursements and inflows in order to maintain stability, and ensures that fund providers can effectively invest in business that follows financial planning guidelines. In the development of growth and expansion plans, which aids the company's long-term survival, financial planning removes the risk of evolving business conditions, which can be easily addressed with sufficient funds. Financial planning will also aid in the reduction of uncertainties that can derail the company's growth. This contributes to the stability and profitability of the company. Knowing the importance of financial planning, there are factors that will impact budgeting of an organization. And my colleague will run through the following points that will affect the budgeting of the financial planning. That is, life cycle of the business. Number 2, financial condition of the business. 3, general economic conditions. Number 4, competitive situation. And number 5, I will close the ending with availability of resources. Matthew?
Thank you, Alex. So let us find out what is the life cycle of business. Although business are inherently unique on its own, but they are often follow a similar trajectory of all other businesses. Life cycle of business is actually the progression of a business where it phases over time. It's similar to how people grow and mature. And these life cycle of business are most commonly divided into 5 distinct stages: from launch, growth, shakeout, maturity, and decline or renewal. So let's start with the first stage of launch. Every company or business begins its operation in this stage, usually by launching a new product or services. It's common that during the launch stage, sales might be low, but it will gradually increase, and with high hopes, it will be in a consistent pace. The business should focus on establishing its identity by marketing to reach their targeted consumer, in advertising the company's comparative advantages and its value proportions in order to stand out among the competitors. But however, as revenue is still low, customer base are not established yet, and its initial startup costs may be high. Business are likely to incur losses in this stage, and it's often considered the riskiest of all the stages. So in fact, throughout the entire business life cycle, the profit cycle lags behind the sales cycle, which will create a time delay between the growth of sales and profit. This lag is very important because it relates to the funding life cycle, which will be explained later. So furthermore, the cash flow in this stage is also negative, but it dips even lower than the profit. So this is due to the capitalization of the initial startup cost, which may not be shown in the business profit, but instead it will be shown in the cash flow. So in this stage, the most important thing is to not to be rushed. Putting time and effort into the launch is how to build a strong base for the business. Not only that, sustainability should be kept in mind. For example, in keeping a balance, especially in hiring, as if you are overstaffed, the unnecessary payroll eats up into the revenue. If understaffed, the business would become less productive. So let's look into the second stage of growth. In this stage, the company or business will experience a steady increase of revenue. Being said that, it will start seeing profit once they exceed the break-even point. However, as the profit cycle still lags behind the sales cycle, the profit level is not as high as sales, which the cash flow during the growth stage becomes positive, which represents an excess of cash inflow. Moreover, with the business now profitable, the owner starts looking for opportunities to grow the business, whereby the goal is to further boost revenue and specifically profiting by marketing, sales, and scaling. So let's look into the third, which is shakeout. During this stage, the sales will continue to increase, but in a slower rate comparing to the growth stage, due to the possible of approaching its market saturation or also an influx of the new competitors in the area of market. Also, in this stage is where the sales is at its peak. Although sales are continuously increasing, the profit starts to decrease in this stage as well. This growth in sales and decline in profit represents a very significant increase in cost as the demand has increased, which will show that the cash flow increases and exceeds the profit. Since revenue growth has declined, one of the ways are to compensate by reducing the expenses. In revisiting expenses in marketing, inventory, and even general operating expenses. So let us look into the fourth stage, maturity. So when the business matures, the sales will begin to decrease slowly, while profit margins getting thinner, and cash flow starts relatively dormant or stagnant. So as the company and business approaches its maturity, the major capital spending is largely behind the business. And therefore, the generation of cash is higher than the profit of the income statement. Moreover, it is likely in this stage, many competitors with similar business has emerged, which would mean the increase of competitors having to reach the maturity stage. It means that the business growth cycle are coming to a close. So at this time, company will have to begin and ask themselves, should we exit or should we revitalize the business? So it's important to note that many businesses extend their business life cycle during the stage by reinventing or repackaging themselves through investing into new technologies or by entering into new emerging markets, which would help companies to reposition themselves into a more dynamic industry, as well as refreshing their growth in the market. So let's look into the fifth stage, which can be separated into two options for the company, decline or renewal. So let's look into decline. This is the final stage of a business life cycle, which means its sales, profit, and cash flow has all declined. During this stage, companies would have or forced to accept the failure to extend their business life cycle. This would mean companies have lost all their competitive advantages and would finally exit the market. So other businesses, they will go for renewal because companies with will and passion will not let the years of hard work going down the drain. So this is an alternative stage to be period of renewal for the business. In other words, it's time to make triumph return for the company and business. This will be a stage where owners has to step back and reassess and should look into the growth of opportunities and find ways to realize them. The plan is to give new life to the business, which means the company will have to be creative and do exploration, experimentation, and innovation. So the plan and strategy for renewal is in place. The business will likely return to growth stage of the business life cycle. Thank you. So I'll leave to the next presenter on the financial condition of the business.
Okay, let's come to the financial condition of the business. A company budget is usually reevaluated practically per fiscal year For some company, management may need to be flexible and allow the budget to be adjusted throughout the year as the financial condition of the business change. They will come with the 5 categories. Number 1 is expenses classifications. Classify the expenses into overhead and production categories will help to set the prices and make decisions when company need to cut costs. Overhead expenses, for example, insurance, marketing, rental, computer, phone, and office staff. Production costs, example, materials, suppliers, machinery, repair and maintenance, and labor costs. Come with the master budget. Create a balance sheet that is a list of assets and liabilities, net worth, cash reserve, profit and loss statement, cash flow statement to monitor the company's ability to pay bills and service debt. Number 3, cash flow planning. Creating a cash flow statement that shows when expenses are due, rather than accurate, and when cash is due, rather than when a sale is made. Number 4, record credit card debts correctly. Don't make the mistake of recording money payment in the budget as an expenses, resulting in a double expenses. Don't forget to add credit card interest to the budget, annual budget. Number 5, variance analysis. Perform budget variance analysis report each time to see how the company is doing. This report shows where the projection different from actual performance, allowing management team to review the information, determine why the projection were accurate, and take steps to change tactics and improve the accuracy of your budget. Okay, for the financial management, accounting definition is a technique to record, classify, and summary financially pattern transaction according to a particular system and then interpreting the result from the above functions. Come with the 3 points: posting and recording. All transactions that take place are usually recorded in certain document or books such as receipt book, invoice, bill, checkbook, and other letters. Posts are made in chronological order. Date. Number 2, classify. The original notes of the transaction were mixed and not arranged by type. After a period of time, the notes are transferred and collected into their respective accounts or ledgers. Among the types of accounts are property, capital, liabilities, expenses, and revenue accounts. Number 3, summary. The entire that have been collected in the respective accounts or ledgers are summed up. The balance is calculated. The balance of these accounts are listed in the 2 columns, debit and credit. In the balance page, trial scales are made to ensure the balance of the accounts before making final statement. Let's come to the general economic conditions. Our teammate Elaine, please.
Hello. General economic condition. Lower financing and borrowing costs. The current low interest rate environment has provided the best opportunity for the business to expand their core business at the low cost compared to the previous financing cost. Hence, the business owner have more budget to expand their business which they have. They will increase the overall employment rate and they are afford to hire more staff. Employment. The employment rate has resulted dropping during the pandemic periods and more of them are suffer seriously from the COVID-19. In current situation, the employment can be increased when the business have more budgets to restructure their business and hire more staff, as well as reset their business up again. Consumer. When the employment rate has increased, more and more people will have their job and pay with salary. Therefore, the overall economy will be better off as the overall consumption will be increased. When more people are willing to spend more and they expect will have the stable income in the future. Monetary policy and fiscal policy. Interest rate up and down drive the economic growth. Hence, the government might lower the tax or offer the tax rebate to stimulate the economy.
Thank you, Elaine, for your presentation. So now I would like to talk about the competitive situation point. So I believe that every work field has their own competitors, and to be success in our own business, we have to understand our competitors' situation, which the analysis of the competitors' budget is also important. Okay, we need to consider a competitor's financial plan that is being spent on the customer to market their products. Nowadays, the average budget resources for both established companies and startups have been clearly defined. On average, 1% of sales revenue is usually allocated for marketing commitments. This is also varies in the industrial sector's business and sales from one business to another business. However, businesses with higher profit percentage like pharmaceuticals spend more than 20% for new product marketing, ensuring sales among the customers. So in a nutshell, the budget is always considered according to the sales benefit and the specific objective aim of the company. So now I will like to pass the last part of the presentation to Alex again.
I'll be talking about the availability of resources, especially for a startup company or even a company that is existing. When they want to look for financial resources, these are some of the resources they can use or is available in the market anyway. Financial resources are used to carry out the business's main activities, such as purchasing products and services and making long-term investments. The sources of fund that organizations receive to fund the finances, capitals, and current activities are available at financial institution, capital markets, and owner's equity are the three main sources of funds of an organization, which is also can call as a capital stock. Equity leverage, debentures, retained profits, term loans, working capital loans, letter of credit, Europe questions, investment funding, and other types of financings are available to the businesses as well. These funds are used in a variety of cases, categorized by one, time span, ownership, power, general source. Financial decisions involve identifications of various available sources. Shareholders' funds and borrowed funds are the two key sources of funds for a business. Equity, capitals, and retained profits are referred to as shareholders' assets. Borrowed funds are funds obtained by the sales of debentures or other forms of debt. Retained earnings are cheaper source of funding since they are portion of funds that are available inside the business. Other tools, both internal and external, may be available as well. Internal financing sources include stock sales, fixed asset sales, retained earnings, and debt collections. Other financial institutions, bank loans, preference shares, debenture, public deposits, lease financing, commercial paper, trade credit, factoring, and other external sources of finance. At the end, before an organization decides which type of financial resources is suitable for its operation, expansion, or for investment, it is vital to have a financial planning to identify and determine which type of resources is suitable for its plans. Thank you.